This is chapter 20, video 6. Ooh yeah, last video. Let's launch. All right, welcome to the last video, guys. Hey, y'all didn't think you were going to make it. Okay, so we're at the end here. I'm excited. I told you guys when we first started I'd be high energy. Luckily, I'm actually shooting this in the early afternoon on one of these days, so I've got a lot of energy. At least I'm not doing this at 10 o'clock at night where I'm like, taxes, whatever, But I'm excited for you. I'm guys, we're gonna get to the end of this. We're gonna learn a lot about good stuff. This video will be, about the same size as the most, I guess, and hopefully we bring this stuff home. So today we're going to talk about the tax bases at risk, passive loss, and excessive business loss limitations from the partnership. And before I go, and I know I've said this 100 times, and look, I'm not getting you guys to watch my videos for my business because I'm trying to do some self-serving purpose. We talk about this at a level that's much higher than we do here in the class. It's not because the class we don't care. It's just that the way that the slides are organized, we kind of talk about it at the 50,000 level. If you want to learn more about this, I highly, highly, highly recommend that you look at my other videos. It's like I said, I'm not doing it for some First of all, I'm not one of those YouTubers who gets paid money. I do this for yucks and giggles. I just enjoy the teaching, and I hope I hope that in these videos you've seen some passion with this. One of the things I've actually been, as part of my dissertation, I've been interviewing other CPAs about some of the stuff that they've been doing. And one of the questions we always ask them is, why did you become an accountant? Why did you become an auditor? And the first thing that they'll say is, I had this one teacher that just really hit it for me. They were really passionate about it for me. And as a result of which, I really felt some cool stuff out of this. And that's why, it's like, I want to be like them when I grow up. Not that I'm suggesting, believe me, I am a flawed human being, just like anyone else. And I don't necessarily need, hero worship or anything like that. But my hope is that when you got done with this whole video series, that you take a look at this and you say, all that stuff that I've been told in the past about tax being boring, about being for nerds, that's not true. Kevin has proven that to me. And so my hope is that you've gotten an opportunity to learn all that stuff. And, I've had a lot of fun. And so, but I'll get into that when I get to the end of the video. But again, I've got a good video series. Like I said, it's probably maybe about an hour long for all 4 videos. You take a look at it, there's going to be a lot of good stuff. And I hope that by looking at that video plus this, you're going to really get some good information out of this. Because look, passing my test is one thing. Yeah, you pass the test, you get a grade. So what? My goal is that when you go to the firm and you start hearing about this stuff, you're going to actually know what's going on. And that to me would mean a lot. But the best part about this thing is that these videos that we're doing for this class aren't going to be online forever. In fact, there's going to be a specific time limit where we're going to pull these videos down and we're going to put up new videos as we go along each year. And you're not going to have access to this anymore, but you will always have access to my other videos because those won't go down. And the goal is to give you that opportunity to see this so that you can see the things that need to happen. All right, so let's talk about this. Operating loss can generate tax benefits when partners can deduct them against other sources of income. That's kind of like that's kind of like a no kidding factor, pretty high there. And then ordinary loss from partnerships are deductible against any other type of tax income. Ordinary partner loss. So if you think about it this way. If I am a member of a partnership and my wife works in a regular job in order to pay the bills so that when the partnership doesn't make much money, we're not eating ramen noodles and macaroni and cheese. If the partnership loses money, we can reduce our total income by how much money the partnership loses when we're not talking about separately stated items. Now, some separately stated items will still generate a good tax benefit. So if the partnership, we got 4 partners. We're going to go back to our flower shop here. There's 4 partners. Instead of being the money bags guy, I'm going to be one of the other partners here. And we're going to say that the partnership loses, we'll say $60,000. Okay. So divide that by 4. You got 15 grand a piece per person. If my wife makes $100,000 a year, I could take that $15,000 and go against her income and bring our income total down to 85. Now the partnership may have other things. Maybe it's got some schedule, some capital gain losses. Maybe we do, in addition to losing money in our flower shop, our investments didn't do so well. That can also reduce down our income items. Maybe we did some charitable contributions, even though business wasn't going all that well. We still felt, hey, we're going to be thrifty. I think you see that a lot with COVID-19 people. Is that basically what happens is, it's going on. I mean, there's a lot of business taking a really big hit. I know some friends of mine who actually own other businesses, and they're still doing charitable contributions, and that shows to the character of the people that I'm surrounded by. But to be honest, I think that, that could happen. So you could have a charitable deduction, and that's going to reduce your income also. But again, it's going to go on Schedule A, not on not on the front page of the return. So there are different areas where you could receive deductions in the separately stated items, but again, you're also going to have, it may not necessarily reduce your income and from the AGI perspective, but it will reduce your taxable income. And that, of course, is a very important thing. Losses are deductible when the partners return only when they clear 4 separate hurdles. Now, in my videos that I do, I usually use the metaphor of the 4 leaky buckets. The 4 leaky buckets. Okay, so the first leaky bucket you have to get past is tax basis. If you have sufficient basis in your partnership, and that's outside basis, not inside basis, but outside basis. If you have sufficient losses, if you have sufficient basis in order to be able to take the losses, it'll leak out from that bucket to the at-risk amount. And then if you have sufficient risk in the partnership, it will leak out from that bucket to the passive loss activity limitation. And then if it's not a passive activity and it leaks out from that bucket to the excessive business loss limitation, it can leak out from there to give you a final number that you can actually use. Now, one thing I do want to say before I go on to the next slide, the business loss limitation has been waived as a result of the COVID-19. That was part of the CARES Act. And so I anticipate that's going to continue on. Basis limitation, in a sense, it represents the amount the partner has invested in the partnership and may have to invest to satisfy their debt obligations. So the partnership may not utilize partnership losses in excess of their outside basis in their partnerships. Losses allowed in excess of their basis must be suspended and carried forward indefinitely until they have current enough basis. So one of the ways that you can, if you're getting to the end of the year, and I pray to God that your clients are coming to you at the end of the year. We do a lot of work with our corporate clients in December, where we kind of say, where do you stand? And when I say corporate clients, I'm also talking like partnerships and S corps. Where do you stand? And they go, wow, we really made a lot of money this year, or we didn't make a lot of money. If you take a look at it, and if you notice that the losses are going to exceed the basis of a taxpayer that you're dealing with, what could end up happening is you can solve this very quickly by saying, hey, does the partner have any excess cash lying around? If they do, contribute it to the partnership. We can get their bases brought up, and as a result of which we can actually allow them to take that loss. As long as it's done with before the end of the year, you're good to go. So you can do that. Losses allocated in excess of their basis must be suspended carried forward. We already talked about that. Partners may create additional tax basis. Oh, that's exactly what I was saying. See, and sometimes I go through this and I'm like, wow, I actually do know this stuff. Sometimes I say stuff and I'm like, yeah, I don't think I know as much about that as I'd like. But this stuff, yeah, I'm pretty confident on. So at-risk limitations more restrictive when compared to tax basis. This is true. The big difference you're going to have between tax basis and at-risk limitations is going to be how the debt is structured. So when you go back to the basis limitations, one of the things that's going to get added to basis is their portion of their loans. Now, as we talk about in the videos that I asked you to go look at, and if you want to learn more information, you can go see that. There are, all loans add debt basis. Non-recourse, recourse, qualified mortgage, qualified non-recourse mortgage financing. All of those add debt basis. That was actually a misconception I was told in a previous, when I was working early in this industry. I was told by people, oh, well, debt basis doesn't get added if it's a non-recourse loan. That's not true. It's an at-risk limitation. And there's some people who have done some mistakes with that in the past. But I'm telling you, you can add any debt basis to the tax basis of your tax basis for your outside partnership. Fast forward to the at-risk limitations. Non-recourse debt is only to be considered at risk if it's non-recourse real estate mortgages from commercial lenders called qualified non-recourse financing. So if this meets this, for example, I go and I buy a building that my business is going to be worked in. I pay a loan over 30 years. It's $1 million. That's going to be qualified non-recourse mortgage financing. That's going to be seen as at risk. I talk about in the video why that's the case, and you can go there and see that if that's what you wanted to see. The partner's limited losses at their at-risk amount. Again, if I have non-recourse debt, that doesn't get added to the risk limit. Recourse debt gets added to the risk limit. Now, some of you might say, how do we divide up recourse and non-recourse debt? Well, non-recourse debt is usually done by the profit loss amount. Recourse debt is going to be done by the amount that you have gone ahead and said, I'm going to be personally responsible for. So if you have all that kind of set up correctly, at-risk limitations are going to calculate correctly, and then you're not going to have too much to worry about there. Partners are considered to be at risk for amounts equal to cash and the tax basis of property contributed. And then also recourse debt and qualified non-recourse mortgage financing that they're having allocated to them. And again, the recourse debt's going to be specifically allocated to the person based upon how much recourse they've gone ahead and accepted. And then on top of that, the non-recourse qualified non-recourse mortgage financing will be allocated normally by profit loss numbers. And normally profit loss numbers aren't different, but if they are different, usually you'll use the profit numbers. Passive loss limitations according to Code Section 469. This was enacted back in 1986 to as a backstop to the at-risk rules applied after tax basis limitations. What was happening before 1986 is that a lot of doctors and lawyers are making all this money, and the first thing they do is they go buy rental real estate because of all the depreciation expense that they get to take off of this. And so the IRS wanted to put an end to that. Not the IRS. Congress wanted to put an end to that. I'm sure the IRS had a hand in that, but this was a way that they could actually get that done in order to prevent a lot of those deductions. Of course, and the reason why they did this is that back in '86 they wanted to lower the tax rates. Well, one of the ways that you lower the tax rates is closing deduction opportunities, and so that's usually this is one way that they did that. So applies to individuals who are also estates, trusts, closely held C corporations, and personal service corporations. We haven't talked about closely held Cs and PSCs. Probably something you want to learn for the CPA exam. Like I said, we don't talk about it here. I think they talk about it in the master's class. Don't quote me on that. Maybe one of these days I'll actually do a video on that, and then if you guys really want to look at it, you can take a look at it. Limits the ability of partners in rental real estate partnerships and other partnerships who don't actively participate from using ordinary losses to reduce their other source of taxable income. I actually don't think this is a bad thing, and I'm not looking at it from a grand level. I've actually seen many times where clients get ticked off because they can't take it on a rental real estate partnership. They're like, "I've got all these losses. Why can't I take them? This is ridiculous." And they throw a few other words out there that are unsuitable for television. But in the end, when they sell their interest in that partnership, they're thanking the Lord and the Maker that they had all those built up losses because it covers all of the capital gains that they got in order to do this. It's kind of a wash in the long run. Getting clients to see that sometimes is a little difficult, but that's our job. We make sure that the clients know what's going on. So passive activity is one that is a conduct, trade, or business or production of income. I know it doesn't say that, but that's what it should say, production of income, in which the taxpayer does not materially participate. In other words, you're not going to work every day trying to make money for this partnership. Now, rental real estate under Code Section 469 is automatically considered passive unless you qualify for the real estate professional exception. And that's usually, there's a lot of hoops to jump through with that because, again, the IRS doesn't want people to do that all willy-nilly. So, Exhibit 20-9 actually has a test for material participation. Individual participates in the activity more than 500 hours during the year. The individual's activity constitutes attachment to all the. I'm not going to read through this for you. I'm going to let you take a look at it. These are the tests that they use, and if you can figure out that they qualify for one of these tests, you can get them to be moved from passive to active. I'll be honest though. I've heard the IRS likes to test this a lot, and some of these are very mechanical. And now when you say I spend more than 500 hours in a year, how do you document that? You're going to have to document that. One of the, and I know this is going to sound insulting, but go get a time clock. You go to work to do this stuff, punch in. You go do the work that has nothing to do with this, punch out. Get those hours so that you can go ahead and you can document all that stuff. That's a way you can do this. Okay. And that can actually be useful. And I'm trying to see if there's anything else that's very interesting there. Oh, probably the biggest one. We talked about this in a previous video. If you're individually materially participating in the activity for 5 of the last 10 taxable years. So say, for example, you decide to take a year off, maybe you're a woman and you're pregnant, you're about to have a baby, or you're a father and you want to stay home with your child for a year. Good on you for doing that, but maybe you drop out of material participation for a year while you take care of your kid and then you start going back to work. What ends up happening as a result of that, the IRS is going to come back to you because you took a year off and then come back to it and say, look, out of the past 10 years, you've been materially participating and you take a year off, and they're not going to come back to you and say, oh, now it's passive. You got to do passive. I'll tell you, that doesn't happen in the foreign world. Once you go passive, once you go passive, you never go back. Okay. That's actually kind of a bad thing. So, so that's something that's of note. Here in this world, if you did it 5 of the last 10 years, you're good to go. You don't have to worry about it. Now, the other one that they talk about, activity involves personal services, including accounting firms, and the individual material participated for a long 3-year period. This is actually one of the few times where accountants, doctors, and lawyers get a benefit out of this. But again, that's kind of how this all works out. Taking into account all the facts and circumstances. Again, number 7 is kind of the catch-all. You kind of go facts and circumstances and do that. Okay, loss limitations. I'm not going to go over this too much, just because I know the CARES Act got rid of a lot of this stuff, and I'm just not going to waste your time with it if it's not going to be a big deal. Now, I don't know, and I'll have to take a look at the law. I just kind of got. It was kind of funny that it came out during tax season. That, hey, they waive the loss limitations. It was kind of like, okay, yeah, that's nice. Going back and actually looking at it, I'm going to actually take a class on this here soon, and hopefully I learn a little bit more about it. If I find out that changes, I'm going to shoot another video, and then I'll get it to you guys, and then we can go from there. All right, so I'm going to go ahead and end it right now. Guys, I can't tell you how excited I am. You haven't, at the time of shooting this video, you haven't even sat in one class. I have sat through all of these videos, and every time that I shot a video, I was getting excited about how we're going to teach this. I think we're going to revolutionize the way we do things here at GMU with this. I sincerely hope that you got a lot of value out of this and that it was very good. I know, and look, I'm not trying to pick on other professors. There's some professors that aren't going to do this. There's others that, like me, that are. I hope you tell me the feedback, whether you thought this was helpful or not. And if it wasn't helpful and you kind of come back and say, I didn't like the videos, just let me go do my thing and blah, blah, blah. Let me know that. Okay. I get, normally the feedback I get is pretty positive, but I've had a couple times where I've had some students who come back to me and say, Kevin, I wish you wouldn't have done this. And that's good because I actually cut that out and then I don't do that anymore. So I think that feedback's important, and I always accept, I try to accept feedback. I try not to let it hurt my feelings. My goal is to deliver you 100% customer satisfaction, because you're paying us to give you this opportunity. And then the hope going forward is that when you go to the accounting firms, they're going to look at you and they're going to say, wow, you had a good education. And that's going to be a very important thing. I'll be honest with you. There's people that I've worked with in this industry, and I won't say what university they came from, but I've worked with them in the industry, and I'm like, where the hell did you go to college? I don't think that either the college failed them or they failed themselves. They kind of just, did whatever they had to get by. I always say, if you put that extra 110, 115% into this thing, you get out of it all that you can. Go to that first job, kick doors down, take names. I had to familiarize that one, because what it really meant. But go out there, make an impression, do the best you can, constantly work hard. Your hard work will be rewarded. Okay, I can tell you that right now, because I'm looking back at my career. And it's cool being the owner. I'm not gonna lie. I enjoy being the owner, but I also noticed that as I worked harder in the industry and worked longer in the industry, I knew that I had a lot of successes and a lot of opportunities were afforded me because I was willing to do that extra amount, and it showed a lot. Well, guys, it's been real and it's been fun. I can actually say this has been real fun. I'm looking forward to seeing you this fall and this summer, because I'm sorry, this fall and this spring, because I am actually shooting this for the spring videos too. Guys, I hope you got a lot out of this, and I look forward to seeing you in class, and good luck going forward.